everybody, and welcome to the most recent edition of our 3 and 3, where it's our goal to share with you the three most important things that we think are interesting and relevant in the marketplace in 3 minutes. So here we go. All right, the first thing we're looking at is I'm sharing my Bloomberg screen, and I wanted to demonstrate that the Eurodollar market is already beginning to cut interest rates, and it began so in the last week. This is despite all the Fed rhetoric that they need higher rates and they intend on higher rates. So let's talk a little bit about this. Let me demonstrate two quick things. First, down here at the bottom, the green lines that are going down are illustrating the change in what the market believes short-term interest rates are going to be in the next, from last week to this week. And you can see that it's cuts across the board with these declines. The other thing I'd like to show is kind of the shape of the curve, which I did talk about last week in our 3 and 3. Just to basically demonstrate that if this was the market's expected pace of interest rate cuts a week ago, the pace this week is faster cuts that are deeper, which is what it demonstrates back here. So in my opinion, what this demonstrates is number one, that the market is starting to price in a change in interest rate cycle. We think this is a big deal, which is why we wanted to bring it to you. Now, the second thing I wanted to demonstrate why we think we could be getting close to a turning interest rate cycle have to do with a swap market. So basically what and I have a demonstrated price field I want to talk about right here. So basically what we demonstrate on our screen is what the swaps market is pricing in right now. It's the difference between 2-year interest rates and 10-year interest rates. Now, the thing I'd like to show you, a couple things. First of all, note that we have bounced right here in 2022 off of a very extreme level, which was actually inverted in those 2s and 10s, which is something that had only happened one other time in the last 30 years, which was May of 2000, which was another period of time when the economy was booming and very strong. The problem happened after that, which is that basically when you move from an inverted curve to like essentially an uninverted curve, it's typically a sign, at least historically, has been a sign of a slowdown, and that a cautious asset allocation investment perspective might be useful. Certainly, that's how we're viewing the market at this point. So what I want to demonstrate is not only do you have the Eurodollar market, which I demonstrated cutting rates, you also have the swap markets, which are illustrating a pattern that would be consistent with a pending peak in short-term rates. And what we think is going to be a nice investing opportunity for the back half of this year in higher quality and longer dated bonds. And we wanted to demonstrate the final part of our thinking in terms of asset allocation and why this can inform your investing kind of going forward. So in yellow here, we demonstrate that same market pattern of how the market was pricing in swaps in 1 year. The more important aspect of this I'd like to highlight is that when we are at such periods as we are right now, you can see this, the white line is a strong outperformance of equities versus long-dated 30-year bond total returns. What I'd like to demonstrate is the last other time that we were at such a kind of extreme level, what you really saw is a very strong performance in longer-dated bonds and a kind of a period of underperformance, particularly of higher valuation equities. This, of course, was the tech crash. So what I wanted to demonstrate are these things that we're watching in the market. We think it's very important. This is informing how we are approaching the marketplace. We don't think bonds are a dirty word, particularly higher quality bonds. And we think it's definitely a great time to be set up appropriately in terms of being defensive with an eye toward risk management. There we go. That's our 3 and 3. Hope you're well.